Imagine waking up one morning, grabbing your coffee, checking the news, and seeing that the global stock market is in absolute freefall. $40 billion. Just gone. Vanished into thin air. You'd probably assume it was a massive corporate scandal, a geopolitical crisis, or maybe a market crash sparked by widespread panic. But what if I told you it wasn't any of those things? What if the reason the world's financial system was teetering on the brink of collapse was because of a single typo? One wrong keystroke. A mistake so simple, so mundane, it feels almost impossible. This isn't a Hollywood movie script. This really happened. This is the incredible, terrifying, and almost unbelievable story of the day. A simple math error nearly broke Wall Street. Our story begins on a seemingly ordinary morning. December 8th, 2005. Inside the frantic, high-stakes environment of the Tokyo Stock Exchange. For the traders working that day, it was business as usual. Phones ringing off the hook, numbers flashing across screens, billions of dollars moving around the globe at the speed of light. Among them was a trader at a major firm, Mizuho Securities. This trader had a simple, routine task: to sell one single share of a newly listed company called The price was set at 610,000 yen, which at the time was about 5,000 US dollars. It was a standard initial public offering, or IPO. Sell one share, make the trade, move on to the next one. A transaction so small, it was barely a blip on the radar of the colossal Japanese market. But in the world of high-frequency trading, where every millisecond and every keystroke counts, even the smallest task carries immense pressure. And that's where everything went horribly, catastrophically wrong. Instead of entering the order as sell one share at 610,000 yen, the trader, in a moment of human error we can all relate to, flipped the numbers. He typed sell 610,000 shares at 1 yen. Let that sink in for a moment. He was trying to sell a massive number of shares, more shares than actually existed for the company, for a price that was practically zero. A single yen is less than 1 US cent. He had effectively instructed the system to give away the company for free. This wasn't just a small mistake. This was a digital bombshell. And the fuse had just been lit. In the sterile, unforgiving world of computer-driven markets, there's no "are you sure" pop-up. There's no friendly assistant double-checking your work. There's just the order and the execution. The moment that flawed order hit the market, the system didn't question it. It did exactly what it was told to do. It started trying to sell 610,000 shares of JCOM at a price of 1 yen. The effect was instantaneous and brutal. Imagine a tidal wave hitting a calm beach. JCOM's stock price, which should have been trading around 610,000 yen, immediately nosedived. The market's automated systems, seeing this impossibly low sell order, reacted with cold, hard logic. The price must be 1 yen. All other buy and sell orders adjusted accordingly. The value of the company evaporated in a split second. On trading floors across Tokyo, screens started flashing red alarms. Traders who were just moments ago sipping their morning tea were now staring in stunned disbelief. What was happening? Was JCOM, a company that had just gone public, already bankrupt? Was this a hack? A coordinated attack on the market? No one knew. All they saw was pure, unadulterated chaos. Back at Mizuho Securities, panic set in. The trader who made the mistake realized what he had done almost immediately. He tried to cancel the order, but it was too late. The digital gears of the market were already turning, and they were turning with terrifying speed. The order was out in the wild, being gobbled up by automated trading algorithms that are programmed to spot and exploit exactly these kinds of price discrepancies. The team at Mizuho desperately tried to send a cancellation signal to the Tokyo Stock Exchange's central system. They hit the cancel button not once, not twice, but 3 times. But nothing happened. The system, for reasons that would later become a major point of contention, simply did not process the cancellation request. The train had left the station, the brakes were broken, and it was careening towards a cliff. The sell order for 610,000 phantom shares continued to wreak havoc, dragging the price down and creating a vortex of confusion and fear. The ripple effect was immediate and devastating. The JCOM stock collapse started to infect other stocks. The Nikkei 225, Japan's main stock index, and a benchmark for the entire Asian economy began to plummet. Why? Because market sentiment is contagious. When one part of the market goes into a freefall, it creates fear and uncertainty everywhere else. Automated trading programs, which control a huge portion of market activity, are designed to react to these trends. They saw the massive sell-off and the drop in the index, and they started selling other stocks to mitigate risk. This created a domino effect. One falling stock knocked over another, which knocked over 10 more. The panic was no longer just about it was now a full-blown market crisis. In the span of just a few minutes, the Tokyo Stock Exchange lost an estimated $40 billion in total market value. A financial black hole had opened up, all because of two switched numbers. The Tokyo Stock Exchange itself was in a state of paralysis. Officials were scrambling, trying to understand how their supposedly foolproof system had failed so spectacularly. They couldn't stop the trade. They couldn't reverse the damage. The entire system, one of the most technologically advanced financial exchanges on the planet, was rendered helpless by what would later be called a fat finger error. It's a strangely casual term for an event that caused such monumental damage. It's the kind of mistake you might make sending a text message, not trading billions of dollars. By the time the exchange finally managed to halt trading for the day to stop the bleeding, the damage was done. Mizuho Securities, the firm where the error originated, was on the hook. They had sold shares they didn't own. To fix this, they were forced to buy back those shares at the now much higher, market-corrected price. The final bill for their single typo, a staggering loss of $225 million. It was one of the single most expensive clerical errors in history. In the aftermath, the finger-pointing began. How could this have happened? Mizuho Securities sued the Tokyo Stock Exchange, arguing that the exchange's faulty system was to blame for not allowing them to cancel the erroneous trade. The exchange, in turn, blamed Mizuho for making the error in the first place. The scandal rocked Japan. It wasn't just about the money lost. It was a profound blow to the country's reputation for precision, efficiency, and technological superiority. The public was outraged. How could the backbone of their economy be so fragile? The pressure mounted, and eventually, the head of the Tokyo Stock Exchange took responsibility and resigned in disgrace. The courts ultimately ruled that both parties shared the blame, and the exchange was ordered to pay a portion of Mizuho's losses. But the real fallout from the 2005 fat finger error wasn't financial. It was psychological. It was a wake-up call for the entire global financial industry. It revealed a terrifying vulnerability at the heart of our modern, hyper-fast, computer-driven markets. For all the talk of sophisticated algorithms, artificial intelligence, and complex financial instruments, the system was still susceptible to the oldest and most basic flaw of all: simple human error. The incident forced exchanges around the world to rethink their safeguards. New rules were put in place. Circuit breakers were improved to automatically halt trading during moments of extreme volatility. Pre-trade checks and price collars were implemented to flag and block orders that were wildly outside of normal parameters. Essentially, they tried to build a system that could protect itself from our own mistakes. They tried to make it idiot-proof. But the question remains, is it enough? Today, our markets are even faster, more complex, and more automated than they were in 2005. Trillions of dollars are traded every day by algorithms making decisions in microseconds, far faster than any human could comprehend. While new safeguards are in place, the potential for a new kind of error, perhaps a bug in an algorithm or a glitch in a complex system, is always there. The JCOM incident serves as a permanent, chilling reminder. It's a story about how our increasingly complex technological world is built on a foundation that is, at its core, human and fallible. It shows that the difference between a normal Tuesday and a multi-billion-dollar financial catastrophe can be as small as one person on one keyboard pressing the wrong key at the wrong time. It's a humbling lesson that, for all its power and sophistication, the global financial machine is and always will be vulnerable to the ghost in the machine, us. Thanks so much for watching. If you found this story as fascinating as I did, make sure to hit that like button and subscribe for more deep dives into the events that shape our world. Let me know in the comments what you think. Could something like this happen again today? I'll see you in the next one.